Hi there, it's James Marley here, Executive Director at Livewire Markets, and welcome to another one of our Fund Manager profile videos. My guest today is Emma Goodsell, and she is a member of the highly regarded equities team at Airlie Funds Management. We're going to speak with Emma about how she got started in the industry, what it's like working alongside some of the real legends of the Australian funds management industry, and she talks about quality and lets us in on what she thinks are some of the highest quality businesses on the ASX today. I hope you enjoy the interview. It's a new perspective, so let's get into it.
So my grandfather was showing me a Commonwealth Bank annual report, and I think the message he was trying to say was something along the lines of, oh, look how many women there are on the board, you could do something like this one day. But I was much more interested in, what's an annual report and why do you have it? And he was explaining, when you're a shareholder in the business, he owns shares in Commonwealth Bank. When you're a shareholder, you get an annual snapshot into how the business is doing. And I found that really, really interesting. So he showed me how to open up a CommSec trading account. And I remember you had to buy $500 was the minimum that you had to buy in shares. So I was probably about 19. I was a checkout chick at Woolworths. So $500 was probably the grand sum total of my wealth. And I bought QBE shares of all things. And no, don't ask the thesis behind it because there wasn't a thesis behind it. And then, a couple of weeks later, I bought shares in a company called Viralytics, which is a tiny little biotech. Which
VLA.
Exactly. If I'd kept it, I probably would have made some money out of it over time. But
I think it got taken over.
It did. It just recently got taken over. It was a blast from the past when I saw that. When I saw that ticker. But basically, I didn't know what I was doing, but I was hooked. Like I would just, update the share prices, hit refresh, see my money's up $5, it's down $5. And I think, so two things. Firstly, it gave me the bug. And secondly, I figured out, had to figure out what I was doing because all my money, not that it was much, was invested in, two companies.
You talked about having an investing bug. Like what does that look like now for you? Like how you, what's been the journey along the way and how have you sort of fed that sort of drive?
Well, at the start, it was reading a lot of books. All the, gosh, it sounds lame, but the investing classics. The Intelligent Investor, all of Warren Buffett's annual reports at Berkshire, Joel Greenblatt books I really liked, and just building up that interest over time. And the whole way through my university degree, and even when I first got started in the industry, just investing myself in stocks, making money, losing more money than I want to admit, but all of it, it's quite cheap kind of tuition when you're out there and you're doing it yourself with your own money. And, now it's become my day job and I sort of think that I've got the best job in the world because, any instance where you can take your hobby and your passion and make it your 9 to 5 is a very good environment to find yourself in.
Well, let's have a bit of a chat about markets
Sure.
and get into how you're seeing what is happening, on the ASX at the moment. Maybe start by just giving me a bit of a sense of how you start to look at the market and identify opportunities. What's the starting point for your process?
Well, I think what's really interesting is the fact that businesses and industries change over years and decades, and yet their valuations are changing very, very rapidly in the market. Some recent analysis that we did, the ASX Top 20, when you think about them, you think they're the most boring blue chip stocks. And yet if you look back over the last 12 months, they've had their valuations change on average by a third. So, if you think about the collective earnings power of those 20 businesses hasn't changed by a third in the real world. And yet their valuations are fluctuating very rapidly in the market. So that for us is kind of a reminder, and it's exciting because there always is opportunity out there. So when we look at the market, you hear these headlines that it's very expensive, and I think, there's no debating that. But we believe that there's always opportunities where assets have been mispriced. So a lot of it's really for us about, digging deep into the work to understand whether or not there's improvements in business quality that aren't yet being reflected in the valuation.
Yeah. So what is an example of, you talk about, and it's something that is in your presentations and your material, is that you're looking for companies where there is a change or an inflection point in their business quality. What are some of the attributes of business quality that you're on the lookout for?
Yeah, so it's a good question. So we look for either dominant or improving positions within an industry. So a good example of that recently that's been a strong performer for the funds has been Qantas. So, when you think of business quality, it's probably not airlines that are the first thing that spring to mind. I mean, Warren Buffett's probably been on a 30-year anti-airline PR campaign. And there's a lot of reasons why people think that they aren't great investments. But when we were doing the work on Qantas, essentially the situation that happened was that Qantas and Virgin had this very costly capacity war, and they tore up the balance sheets of both companies. And coming out of that, we were looking at the domestic industry structure in Australia, and actually, it's a pretty attractive structure because you've got this fixed profit pool it's not large enough to support a third player. You've had, in the past, a third entrant try and fail to survive in the Australian market. So it really, really only supports two players. And then within that, when you've got your second player that is forced to act rationally, because Virgin has this balance sheet constraint, that's a very favourable position for the dominant airline. And then when we were looking across the world at other market structures, you had these businesses overseas that were much more competitive, many airlines, and yet they were trading on higher multiples than Qantas. So those are the sorts of anomalies that we're looking for. So we invested about 2 years ago, and that has largely that valuation anomaly has closed out. But we're always looking for, Wesfarmers is another recent example where we think that the portfolio rationalisation that Rob Scott has come in and done phenomenally well has re-rated the business towards the better quality businesses. So by spinning off Coles, by selling the coal assets, and by exiting UK Bunnings, now Wesfarmers' business has a better balance sheet, lower capital intensity once they actually go through with the spin-off of Coles, and more of its earnings, about 70 or 75% of group earnings now will be coming from Bunnings and Kmart, which we think are two very, very strong businesses within the Australian economy.
Obviously, Matt and John didn't hire you to come in and think the same way that they think, and I'm sure that you can bring a new perspective to thinking at Airlie, sort of within the guidelines of there is an investment process. But could you give me a sense of some of the things that, and some of the ways that you challenge the thinking internally, or new ideas and new perspectives that you can bring to the team?
Yeah. So I think, if I think about John's real strength is he has very, very disciplined rules when it comes to valuation, very conservative approach to valuation. And I spend most of my time on business quality, and that I think is just the nature of who I am, and that's it's a conviction fund, and we have large positions in our best ideas. So when I think about the nature of building conviction, for me, it's getting out there in the industry, talking to everyone up and down the supply chain that can give me any information about a story, and really building that thesis from the ground up. So when I have what I think is a good idea, all of my conviction is centered on my thesis and the business quality. And that's not to say that it doesn't pass the other factors, because the nature of our process is every idea in the fund not only has a business quality argument, but also a valuation argument, good management, and a good balance sheet. So once the boxes are all ticked there, then we invest. So when I think about ways that maybe I challenge their thinking, a lot of the time my excitement and my conviction is coming from all the work that I've done on an industry. So a lot of our discussions are then about getting that view over the line with respect to these very strict, conservative valuation rules, which is good because when you marry those two disciplines, the nature of doing very, very deep, detailed work and trying to figure out, and trying to come at things from an encyclopedic knowledge almost of what's going on in an industry and a business, with the fact that you can have exogenous changes in an industry. You can have regulation risk seems to be rearing its ugly head every second day in Australia. So all these factors outside your control mean that if you are wrong in any part of your thesis, then from a valuation perspective, a stock that's got a very high valuation, the downside becomes very skewed. So I think the combination of having the people who think along those two lines and put weight on those two things is very valuable, because it leads to a portfolio that's constructed of, very strong, detailed theses around business quality, but also, very strong valuation arguments and ways that you can see a path to upside. Because what you don't want is to end up, for us, we don't want to own necessarily the best businesses in Australia at any price. We want to own good businesses that, maybe one standard deviation better than the norm and trading at one standard deviation below the norm. So we're looking for, we're always making trade-offs, and we're not comfortable owning those really exceptional businesses at really exceptionally high prices. Yeah. So I think in terms of how I guess I challenge the thinking of, these two very, very good seasoned investors, I think it's more about, if I can really see and have conviction in the 3 to 5 year story, sometimes I have to kind of get them over the line a bit with respect to some of the the near term valuation hurdles.
Yeah. Have you got an example?
An example. So we own CSL in the fund, and I think that when I started at Airlie, the easiest thing to do would have been to have a discussion with John and Matt and say, don't buy CSL, it's too expensive. That's the kind of argument that would have gotten a lot of purchase in a very value focused investment team like Airlie. But you look back over the last 2 years and that hasn't been the right call. And I think that the work that I did there and the reason that I had so much conviction in that story and pushing it in the funds is that you had this step change in the business quality. So it's a 3-player market, and their largest competitor, which had always been Baxter, had recently been acquired by Shire. And a big part of our process is pulling together the story and validating all our assumptions externally. So as I said, a big part of it is going out and talking to anyone that will talk to you. So for CSL, that, because it's a global company, that means getting on a plane and meeting all their offshore competitors. So I had a meeting with one of their smaller competitors, in which the head of the US business there was telling me that you wouldn't believe the quality of the people that Shire are letting go in the Baxter marketing team. These are 10-year, 15-year plasma guys. They're the best of the best. And the next day, I attended a global healthcare conference where Shire was presenting, and they had said, we're missing our revenue targets for the acquisition, but we're going to make our guidance because we're increasing our cost out targets. So putting those two pieces of information together, I concluded that this is a long duration industry, and that this business was potentially making very short term decisions to hit short term targets rather than investing for the long term. And what that meant for CSL, who had their heads down and were making those long term decisions, it meant that you'd had this kind of step change in the competitive intensity, a step change down potentially, while you had this competitor distracted by this merger takeover dynamics. And the other thing, that's important for CSL is that it's a 5-year capex cycle. So if you want to be able to meet where you see demand going in 5 years' time, you have to be putting in place the investments today. So while their competitor was distracted for the 2-year period that it was, I think that CSL is now in the midst of a 5 or 6 year upgrade cycle as a result of making those investments ahead of its peers. And then the question being, the next obvious question being, I guess, the valuation today, because the share price has moved from about $120 to $200. And I think the other business quality change that's now occurred has been that Takeda have bought Shire. So not only has it gone through one set of hands, it's now going to go through another set of hands. So that dynamic that has led them to take their eye off the ball in terms of long-term investments potentially plays out for another year or two at the very least. So I think
a potential lame competitor for CSL.
Exactly. So that's an example of where we've had to have this valuation versus business quality debate. And that's not to say that there wasn't a valuation argument there. So we did a lot of work looking at, we looked at 55 of their global healthcare peers, and we looked at the returns profile of those peers versus the valuations. And when you plot them on a chart, CSL was bang in line with what you'd expect its multiple to be versus global peer set for the quality of the business. And we look at the returns profile of the business as a proxy for its quality. Mm-hmm. So we looked at that and said, well, actually, the valuation makes sense. It's not an anomaly. And going forward, we expect the return on investor capital to continue to improve as a result of this sort of changing market dynamic. And so, we think that there's still a valuation argument there, that not only does it deserve its higher valuation, its higher multiple, but that, it should continue to outperform as a result.
Interesting. We nearly got to a discussion around selling then. But obviously CSL continues to meet some hurdles. Can you give me an insight into the sell discipline? I mean,
Yes,
owning stocks is one side of it, the sell is the other. Can you give me a bit of an insight into how you think about realising positions? Obviously, you'd love to have a grower like CSL that goes on forever, but clearly there's times where stocks don't meet that valuation. What's the sell discipline?
Well, I think, firstly, you've got to think about what you're owning. So if it's a company that is something like a turnaround play, which we like because often, what you're betting on is mean reversion. So it's a bad company that's going to revert to the mean and just be an average company. I think in those instances, we like those situations because they usually have a lot of assets, they're cash rich, they just need, new management or better execution of strategy. And then, you get this reversion to the mean in the valuation. And in an instance like that, you've got a lot of conviction on the valuation argument because you often have, replacement asset value or transaction comps or peer comps or some external piece of information that could guide you to what this business might be worth if they fix, their issues. But the flip side of that is you have to be very, very stringent on the valuation, and your sell discipline comes in, because there is no franchise value in these businesses. They really are sort of almost an asset value play. So you have to sell them when they approach your assessment of fair value. So if I looked across the fund at the moment, Clydesdale would be an example of a business that we consider a bit of a turnaround. It is a sort of average, in terms of its market position, an average regional bank in the UK. But we think that there's a good ROE improvement argument in that story, just from a cost out perspective. Clydesdale is one that we, keep a very firm eye on in terms of watching as the valuation approaches our assessment of fair value, because, you can't be lax on that because there really is no franchise value there. Where it gets more difficult and where we spend a lot of our time debating is on the companies that do have this sort of invisible franchise value, because it's more difficult to value. CSL would be one of those. So really the sell discipline comes in there in testing, doubling down and testing your thesis and making sure that you haven't really seen any directional changes in that. We've spent a lot of time debating Qantas, for example, because it really, the valuation argument has really played out in terms of that gap versus international peers closing. And from here on in, what keeps us in the stock is the fact that, the business quality argument that we originally identified, which is, the fact that the domestic market is a very rational market, that dynamic hasn't changed. And we've got oil prices increasing, but you could probably argue that if there was ever a period where Qantas would be able to pass through the effect of higher oil prices, it would be now, when their competitor, if Qantas needs higher oil prices passed through, then Virgin definitely does, because, their balance sheet is still, in such a precarious situation. So we like the domestic structure still. We haven't seen any evidence of that changing. I mean, what might change our view in there, in that case, would be evidence of a third entrant, cashed up.
Irrational pricing.
Exactly. So something like that. We'd have to see some risk on the horizon. So we spend a lot more time testing our thesis and checking whether our thesis is playing out, and that's more likely to, for these high, these franchise value stocks, that's more likely to precipitate a sell. But that said, we do have a very strong assessment of fair value and a very strong valuation discipline. So if valuation gets extreme on some of these companies that we think are very high quality, then we are happy to trim or completely exit the idea.
You've spent a lot of time talking about quality and trying to find really high quality businesses, and your anecdote or your story on CSL really talked about the focus you've put there. If I had to ask you to name sort of the 3 highest quality businesses that you think that you're looking at, could you run me through some of the businesses that you think have exceptionally high quality?
We're not macro investors, but I would start by saying when we look across the Australian market, we have this view that things get incrementally harder for the consumer from here, just as a function of, tailwinds of the housing cycle fading away, highly indebted households, and very sluggish wages growth. So we think it's reasonable to assume things get harder from here. And so when we look across the portfolio, we really want to own those businesses that have dominant franchises and have something special. So we're happy to own businesses like Qantas, Reece, the wholesaling plumbing business, Bunnings, Kmart. We think these are all very, very fantastic brands that have dominant positions within their niches. So we think they're fantastic businesses. The other qualities that we're looking for in businesses are pricing power. And I think this is really an interesting issue that's coming to the fore at the moment. There's been a big sort of offshore earner trade over the last few years. But when I look at the US, I think they've had a very prolonged period of very low inflation. And that has allowed corporates to expand their profit margins with or without pricing power, just because their cost bases have been so benign. And now that's coming to an end, and you're getting a lot of US businesses seeing their cost base completely rip. And it's exposing those that did and didn't have pricing power all along. And I think, when we look at, I've done a lot of work on James Hardie and a lot of work on Brambles. We invested in James Hardie because, both businesses have had significant cost inflation over the last year. But James Hardie, because they have that 90% category share of fibre cement, they're able to push through 5% price increases to the channel, and the channel just absorbs it because they are the market. When you look at Brambles, they've had issues in passing through the cost-based increases in lumber and transport, and as a result, I think their margins will come under pressure from here because they lack pricing power with their immediate customers, and also the competitive dynamics there. They've got a number two that's very happy to pinch contracts off them whenever Brambles contracts are up for tender. So, you've got these two businesses that are, ostensibly good businesses, but in this current, sudden return of inflationary environment, we really are careful that the businesses that we invest in do have pricing power.
What's the most important discipline that Matt and John have tried to impress upon you while you've been working at Airlie?
Well, it's a good question. It's quite topical for me at the moment because the stock that I'm about to talk about is currently in trading halt for an earnings downgrade. But so probably about 12, maybe 18 months ago, I had a chat with John and I was recommending that we invest in RCR. And RCR are an engineering contractor, and we've got a small small companies fund that can invest in smaller opportunities. So I thought it would be a good fit for that fund. And basically, what I was attracted to about the idea was, this growth in renewables projects, and they had very good knowledge of how to execute on those projects. So we saw them winning a lot of that work. And then I thought, resources, the CapEx cycle was coming back, and that the business would pick up there. But when I was modeling it, I was putting in assumptions for margins and thinking the whole way through, well, I don't really know, the nature of contracted businesses, they run off very skinny margins. And as an outsider investor, they're announcing work that they're winning, but you don't really know how the contracts are structured, if they're priced correctly. And if they're not priced correctly, then you get these massive cost overruns that have to be paid for by the contractor. So actually they can be, in a concentrated fund, they can be terrible investments because, just like now, you come into work and there's a trading halt and they announce that one of the contracts they mispriced and there's big cost overruns. So I took that idea to John. He sort of smiled at me and, probably looking back, humoured me with it, but he didn't invest. And I think, when I look back, the lesson there for me was, if you can't understand how cash is flowing through a business and really have a high conviction about the profitability level of a business, then you can't value it. And if you can't value it, then you can't invest in it. And John knew that immediately. And he was probably too kind to tell me, that it didn't really suit our style. But I think that's a good lesson for me, working with these guys that are so experienced, because they have this phenomenal framework. And so, maybe for them, a contractor is a business that you would own when the balance sheet is absolutely pristine and they're announcing that they're winning work. But you wouldn't actually want to own it when they're delivering on that work, because you're taking on all that execution risk as an investor with very little ability to sort of get your arms around, what that risk looks like. So they have a playbook there, and I was developing the playbook, but, they knew enough not to sort of be tempted by ostensibly cheap valuations in this space. So I think that, you know, day by day as I'm working with these guys, you know, you always get these opportunities come up where their experience and their honed instincts keep them out of, you know, bad ideas. And, you know, I can only hope that over time I can develop, you know, the same kind of compound knowledge.
Awesome. Well, listen, thank you very much for taking the time to sit down with us. You've been really open with all your stock ideas and your thinking, and all the best with the launch of the fund.
Thank you.
And, you know, thanks again for sitting down with us.
Thanks so much.